Start recording. There it is. So, our last online class. Week 17 right now. Let me start sharing Moodle. First announcement, and then we'll move on to what you might expect on the exam. Okay. Sharing the screen right now, switching to Moodle, week 17. Our online class today. First, a bit of an announcement. Where is it? Somebody is entering? Right. So first, a bit of an announcement. There is a new forum over here. That's the last third forum for this semester, where you simply have to share your opinion, okay? And I'm not going to prove you either right or wrong. You're not sharing any facts here. So just as you did with other forums, if you didn't, make sure you reply to questions within other forums as well. Okay, just click enter and reply to this question in the forum about interest rates, about risk-free rates of return. Right? So it's just simply in your own words, simply your opinion. Okay, so you have about 1 week for that, right? When I collect the final exams, I will check your entries for the forums as well. And remember, those are graded too. Those are also graded. Although for forums, we have only 7% for all three forums together. So each entry into your forum discussions is more than 2%. Not extremely high, but you might still want to pick up those 2 points if you want a good score. And of course, next week is your final exam, okay? So let's switch back to us. Final exam clearly is going to be online, same as for Financial Management 1, okay? Final exam will appear on Moodle. You will download an Excel file, and it will have, as far as I remember, 6 problems. I have already prepared the final exam. We're going to discuss the details today. I already know what is there, so you want to pay attention, right? So 6 problems. Some problems have 1, some problems have 2, some problems have 3 questions. On average, 2 questions. 6 problems, that's around a dozen questions. I will give you about a couple of hours for that. That should be more than enough time, okay? So 2 hours for 12 questions, about 10 minutes per question should be fine, okay? So, because you only have 2 hours, and because it's an online exam, it's not an exam when you have to go into the classroom, it's easy to be late. Right? It's easy to be late because you don't have to go out of your room, go to the classroom, you don't need to leave the dormitory. So you might have a tendency to sleep late, right? Thinking that you don't need to go to the classroom. So it's easy to be late on the exam. But if you are late, it just means you have less time to complete the exam. There will be only 2 hours to complete the exam. After the deadline, there will be an extra 10 minutes just in case if your internet is too slow. After that extra time, Moodle will not accept your file. Moodle will not accept your upload. So don't be late to the exam, okay? So let's start the exam around 10:30 should be fine, I guess. We can start the exam at 10:30. Your deadline will be 12:30, and I will tell Moodle to accept the files until around 10:40, 10:45. Just in case if your internet is pretty slow, okay? So don't be late. What else? What is the exam going to cover? Let's share the screen again. Let's share the screen again. Okay, going back to Moodle. The exam is going to cover the last 4 chapters. So that's lecture 6, lecture 5, lecture 4, and lecture 3. Let's go through them, okay? Lecture 3, that's chapter 10 in front of you. I hope I'm sharing the screen properly. okay? There is not that much here, okay? Because I'll give you a bit of a hint. We're not going to look at these simple sort of types of return for the exam. Clearly there are income parts of the returns and capital gains. Okay, we're not going to look at that on the exam. So we're scrolling down to risk premiums. Okay, where is it? Risk premiums over here. Okay, there will be an exam question where you have to calculate average return, standard deviation, variance. Okay, but trying to be a little bit tricky on the exam so that it's not too easy. Okay, perhaps instead of the actual returns you might be given risk premiums. Okay, so don't confuse risk premiums with returns. If you have to calculate average returns, if you have to calculate variance, standard deviation, all of that you have to do on the return data. Okay, on the data of returns over the years, on the data of your profitability over the years, right? Can anybody tell me how can I find returns if I have risk premiums? Let's go back here. That will be one of the first questions you will have to deal before you can continue. So you got the data on many years, right? And all of that data is on risk premiums. Okay, and let's say you have to calculate variance. What do you do? Anyone? Okay, simpler question. Returns minus risk premiums equals returns minus risk premiums equals okay, maybe I'm talking here and my microphone doesn't work. Can you guys hear me? Anyone? Maybe my speakers don't work. Can anybody say hi?
Hi, Professor.
Okay, good.
Hello.
Right. So my speakers work and you hear me. I think you hear me. Okay. Perhaps it's a bit too early during the day and we are still a little bit sleepy. You are still sleepy. We don't remember anything about anything. Well, what was our question? Return minus risk premium, I think, correct me if I'm wrong, is equal to risk-free rate of return. That is the difference between those two. Okay. Anyway, I'm dropping you a lot of hints now. Okay, which you will have to use next week during the exam. Let's go back. Where were we? We were here. Okay. Right. Okay. So there's that. Then within this chapter, we looked at calculating average returns. That's pretty easy with Excel. You can just hit equals average and give it the data. We also learned to calculate variance and standard deviation for this table, involving several steps over here. You calculate the average return, then you calculate the difference between each of these returns and the average. Do it multiple times, then you see the differences. Some of them are positive, some of them are negative, all of that. Actually, there is a quick shortcut which works for this chapter. okay, which works for this chapter. Let me open Excel, zoom in a little. Let's look at these returns that we have here: 11, 14, 37, 13, 43, 31, negative 8, 91, and negative 25, 26. Calculating variance involves several steps over here, same as for standard deviation. In Excel though, I think you remember, we have simply equals var.s for sample, give it the data, there it is, 859.19, 859.19. Okay, same for standard deviation. Equals stdev.s for sample. We're not talking about the population here, right? There it is, 2931, 2931. Okay. But this shortcut only works for this chapter where you have actual returns for the actual years. Okay, so if you have years like this and returns like that, these shortcuts work. Otherwise, they do not work in one of the next chapters. We'll come back to that in several minutes. Okay, so that's pretty much it in this chapter. There is also geometric returns, yes. Geometric returns or geometric average. We talked about different kinds of averages several weeks ago. Okay. Imagine in 1 year you have a return of 20%. In the next year you have a return of negative 20%. 20% and negative 20%, simple average is 0%. Did you actually make $0 over these 2 years? No, you actually lost money. Imagine you start with 1,000, make 20%, you're up to 1,200. If you lose 20% of 1,200, you are down to 996 or whatever. So you actually lost money. How come? That's because of the difference between simple return and geometric return. Simple average and geometric average, okay? Again, a lot of steps over here to calculate geometric returns. In Excel, equals geomean, okay, of these returns. But it doesn't work with the returns themselves. We first need to convert them to 1 plus the returns. So equals 1 plus these returns. I'm going to divide them by 100 to make sure it's in fractions rather than percentages. Double click. So this formula doesn't work with the returns themselves. These are the returns in percentages. This formula only works with 1 plus the returns in fractions, not in percentages. Okay, that's another reason why I like fractions. And this formula is programmed a little bit not really correctly in Excel. Our answer here is 108%. Yeah, you will end up with 108% of whatever you started with, but the actual return is only 8.2%, 8.3%. It's also somewhat confusing in the textbooks. Different textbooks you look at give you different answers. 1.8% here, just 8% here. Okay. If you, where is that formula? Oh, here. If you look at the formula for the geometric average, some textbooks do have this -1 here, some textbooks don't have this -1 here. When we looked at it several weeks ago, I told you to do this by hand. So for the exam, big hint, a lot of people forget this because we do it by hand, okay? We're gonna subtract the -1, we're gonna subtract 1 to find out the actual returns. Actual return you make here is 8.3%, 8.3%. Okay? Right. That's mostly it for this chapter. After that we have some theory on efficient market hypothesis, but in our exam we will not have any theory-based questions. You will only have to calculate things. Next chapter. Okay. Risk and return. Okay. So basically it's about portfolios and stocks and portfolios. Okay. Where we calculate average return, where we calculate expected return, where we calculate variance and standard deviation for particular stocks or a portfolio of stocks. Okay, so a bit of a repetition. I'm not going to look at particular stocks because a portfolio of stocks is more interesting, so you can skip all of this, move on to portfolios, right? And when we talk about portfolios as opposed to just investing in one stock, what you will need in those calculations is the weights. Basically the percentage of your total amount of money that you invest into this particular stock. So if you have invested in A, B, C, D, E stocks here, 5 stocks, in total you invested $50,200, and out of those, if you invested $15,000 into stock A, that's 30%. Okay. Right, so you'll need weights. Everything else you will be given. So generally you will have different scenarios for the state of nature. Okay, maybe there's a recession happening, general growth, or quick expansion, economic boom. Okay, and you'll have your probabilities for all of these states. Probabilities adding up to 1, of course, yes. You have different stocks that you invested into, and you'll probably have to calculate your own weights. If you only have, just like here on the screen, if you only have these amounts of money invested, you can simply calculate those weights and you'll be given these returns. What will happen to your investment from stock V, for example, if a recession happens? In that case, your returns from investing into stock V are going to be negative 20%, and so on. So for this, you will have to calculate basically 3 things: portfolio return, portfolio variance, portfolio standard deviation. Okay, let's zoom in a little. So for portfolio return, you have to look at these states of nature one by one to calculate the portfolio return. Okay, so look, let's say recession here. In case of a recession, how much is my total portfolio going to give me in terms of a return? Well, on 30% of my money, I'm going to lose 20%. So 0.3 times 0.20, plus on 17% of my money, I'm going to earn 18%. So plus 0.17 times 0.18, plus on 22% of my money, I'm going to earn 5%. So plus 0.22 times 0.05, plus 0.2 times negative 8%, plus 12% times 4%. The answer is going to be 3% negative. Let's have a look at an example here. Maybe we're going to somehow copy these numbers. Give me a minute. Negative 8% and 4%. Weights. 30% of my money invested here, 17% of my money invested here, 22% of my money in the third stock, 20% of my money in the fourth stock, and 12% of my money in the fifth stock. Let's double check if it's equal to 100% of my money. No? How come? 101%. I guess there must be some rounding here, so let's calculate our own weights. 15, 8,600, 11,000, 9,800, and 5,800. The total is 50,200, and we want to find the weights. Okay, equals this amount divided by the total portfolio value. Fix it. Okay, there's the approximation. Instead of 30%, it's actually 29.88%. And copy. Okay, so this is this. This is this. This weight is 21.91%, this weight is under 20%, and this weight is under 12%. Okay, there it is. Okay, so for a case of recession, what's our portfolio return? Equals, as I said, on 30% of my money, I'm going to earn 20%. I'm going to lose 20%, plus on 17% of my money, I'm going to lose 18. I'm going to earn 18%, and so on. Okay, as you see, negative 3%, rounded up in this example. Okay, so that's only the case of recession. In case of a regular growth, neutral growth, let's say we're going to make 13%, and in case of a boom, quick economic expansion, we're going to make 17%. Okay. To find the total portfolio return, we need to multiply these numbers by the probabilities. So the probabilities were 25%, 50%, and 25%. 25%, 50, and 25. So equals the returns times the probabilities, and add them up to get to 10%, as in this example. And somebody wants to join, right? Okay. So clearly things like this, and you will also have to calculate variance and standard deviation. I've just mentioned to you that when you have the actual years like this and the actual returns, you can calculate variance and standard deviation pretty easily with Excel. In this case, you cannot do that because you don't have the actual years and actual returns. You don't have the historical data. You're looking at the future, and we don't know whether recession, neutral, or boom will happen. So in this case, when you calculate variance and standard deviation, there is no shortcut. You have to go through all of these steps. The first step is to calculate this expected return of the whole portfolio, or the average return of the whole portfolio. This is what we've just done, this 10% example. Next step is to look at the deviation, or look at the difference. The difference between the return for the particular scenario and average return. As in the example we've just looked at, in case of a recession, the portfolio return is going to be negative 3%. Negative 3 minus 10% is going to be negative 13. In case of a neutral economic growth, the portfolio return is going to be 13%. 13% minus the average, minus the expected portfolio return, is going to be 3%. 17 minus 10 is 7. So this is the difference. Okay. Some of them are negative, some of them are positive. As we've talked about this many weeks ago, we take a power of 2 of everything to make everything positive so they don't kill each other. Okay. Next step is to multiply this squared difference by the probabilities. Okay, 0.01663 multiplied by 25% is going to be 0.00416. Do that for the other numbers, add them up together, and you get variance. Okay. To get to standard deviation, you get a square root of variance. So equals SQRT 0.005, what was it? 73259, 73259, gives you a standard deviation of 0.76. There it is. Okay. So that's mostly it in this chapter. Systematic risk, there's some theory there. Beta, well, for beta, yes, CAPM, yes. There is something else in this chapter. CAPM, capital asset pricing model. A couple of formulas here, okay. Expected return, or the required return, sometimes the textbooks confuse those two, okay. Risk-free rate of return plus expected market rate of return minus the risk-free rate of return. This difference in the brackets is the same as the risk premium. That's why there are two formulas, times the beta. Beta is a level of systematic risk, right? So you will have to use this formula on the exam for sure, one of these two formulas. And I will also give you a hint right now. You will have to rearrange, sometimes you'll have to rearrange this formula to find some other components except for the required rate of return, right? You can do that, that's pretty simple, right? If you have this formula, for example, and you have to find some component for a given required rate of return, you can easily do that. High school rearrangement and you're done. What else did I want to mention here? Oh, a reminder. How much is beta for government bonds? Anyone? How much is beta for government bonds? A minute ago I said beta is a measure of systematic risk. Yes? So there are different measurements of risk. Beta is a measure of systematic risk because there are different kinds of risk. Right? How much is beta? How much is risk for short-term government bonds? There will be something about short-term government bonds, and you'll have to calculate something related to betas and stuff like that there. So this question is extremely useful for next week. Anyone? Anyone? How much is the risk of short-term government bonds? Anyone? The risk is basically losing your money, right? So how much is the risk of short-term government bonds?
Almost zero.
Yes. In finance, we assume it's zero. Although maybe tomorrow there is an earthquake and the whole country just disappeared. But I mean, how likely is it? Or maybe aliens come tomorrow and kill us all. But we just assume it's zero, right? So beta for short-term government bonds is equal to zero. Okay, you'll really need that. Okay, that's mostly it for that chapter. Okay, cost of capital. Okay, three sources of capital. Okay, there are three sources of capital. Equity, that's the usual stocks, shares, right? Preferred equity and debt or the bonds. Okay. So first thing you'll have to be careful when looking at the cost of capital question. There will be a question on cost of capital for sure, right? Is when you look at the dividends, right? Remember I said there are three sources of capital, right? First is equity, general shares. Okay, we'll need to calculate the returns on shares because the returns that you get as an investor in shares is the cost of capital that the firm will have to sort of guarantee, not really guarantee you, but attract you with. Okay, so one thing you gotta be careful about is whether you are dealing with the next dividend or the last dividend. Okay. Next dividend, D1, is the last dividend plus the growth rate. Okay. So when you are reading the exam question, you just really gotta be careful if the dividend is about recent, past, last, have just been paid, have been paid. Anything about the past is D0, right? Anything about the future, next, upcoming, the expected, whatever dividend, it's all D1, right? So if, for example, D0 is $10 and the dividend growth rate is 10%, if D0 is $10 and dividend growth rate is 10%, clearly D1 is equal to
11.
Yes, 11. Very easy, but just to make sure everyone's on the same page. Okay, so that's about stocks. Okay, preferred stocks. Where are they? Okay, debt. Debt is first here. For debt, we just need to calculate market rate of return. Okay. So you might have something like price of the bonds, face value of the bonds, right? The coupon rate, right? How frequently the coupon is paid. Okay, this is one thing that sometimes even I forget to take into account, right? When we calculate the market rate of return, right? That's just the formula equals rate. Yes? I need to remember to make sure that I look at the annual rate. If the frequency of the dividends of the coupon payments is semi-annual, for example, then I need to remember by hand to multiply this by 2. If it's quarterly, I need to remember by hand to multiply this by 4. Anyway, so I need to remember about the frequency. Okay. So basically, the rate on the bonds, right, is the market rate of return. Okay. So for example,
Professor, I think you haven't shared the screen yet.
oh, okay, thank you. Okay, so we might have price of bonds, face value, coupon rate, how frequently the coupon is paid, right? And of course, duration of the bonds. Is it a 3-year bond, 5-year bond, whatever? Okay, that's NPR, of course. Okay, let's call it NPR. NPR. Coupon rate is going to be the PMT, regular payments, right? Okay, so you'll have to calculate the rate. But one hint I give you here, right, is remember what is rate. Remember what is rate. It's just market rate of return. Okay? Market rate of return. So for example, if the face value of this bond is, let's say, 1,000, and just for simplicity, let's say it's annual payments, so we don't need to kind of bog down with frequency, and let's say the payments $60 a year. Okay, and if let's say the market rate rises from 6% to a significantly higher rate of return, what will happen to the price? How do you guys think? Will it increase also or drop? So when the bond was issued, it paid 6%. And let's say the market rate was also 6%, just for example. But since then, market can give you very high returns, whereas this bond still pays 6% compared to the face value, right? What happens to the price? Does this bond seem attractive? How do you guys think? If the market is much higher now, in terms of the return you can get, does this bond seem attractive? Anyone?
No. So
No. So what happens to price?
So the price decreases?
Yes, price will go down, right? Price will go down, right? So let's say to 800 or whatever. So that's what will keep the bond in equilibrium, because if the price goes down to receive these $60 in payments, you'll have to buy the bond for lower price instead of the original face value of 1,000. So the next buyer will receive $60 on 800, not on 1,000. So his return is going to improve, right? Okay, so that's what keeps the bond in equilibrium. But perhaps the main hint here you will definitely need next week is this over here. Okay, what is the rate that you need? It's the market rate. Okay, what else do we have? Oh yes, one thing you probably might forget, or maybe not, because you'll have your formula sheets in front of you and everything. But anyway, when we look at the weighted average cost of capital, please remember to look at the after-tax cost of debt. Okay, not before-tax cost of debt. We need to make sure to look at the after-tax cost of debt, which is the before-tax cost of debt. What is the before-tax cost of debt? It's this rate. This rate is the before-tax cost of debt. Multiplied by 1 minus the tax rate gives you after-tax cost of debt. That's because there is tax shield. With debt, you pay less tax, right? So the actual cost of capital for a company will actually be lower. Okay. And for preferred stocks, it's simply the ratio of dividends, fixed dividends, over the price, right? Yes. So let's say we have, how much is it? 60 over 800. For example, let's say it's a 1-year bond, just to keep everything simple, that's 7.5%, right? And let's say we have 50 million here in debts. Let's say we have beta equal to, let's say 1.6, okay? Let's say number of shares outstanding is, let's say, equal to 20 million shares, and let's say risk-free rate of return is, let's say, 0.01%, and risk premium of the whole market is, let's say, 9%. Okay, let's make it 9%. Okay. And for preferred stocks, let's say the fixed dividend is, call it $10, doesn't really matter. And the price of preferred stocks is, let's say $120, $110. And how many preferred shares do we have? Number of preferred shares outstanding is, let's say, 5 million shares. Tax rate is, let's say, 20%. Okay. How much is the weighted average cost of capital? Well, we need to calculate cost of equity. That's the required return of these stocks, right? Required return on these stocks. Required return on the stocks, risk-free rate of return, plus market risk premium times beta, right? So that's going to be, let's change this, make it 2, make the calculations easy. So 9 times 2 is 18, plus 1 it's 19. That's 19%, right? That's cost of equity. Cost of preferred stocks, simple ratio here, that's 9%. 10 over 11 is 9. I mean 1 over 11, yes. Something like that. And cost of debt, call it 7%, I mean 7.5% from here. Like that. Okay, a bit more detail here. Okay, here as well then. What's next? After tax, right? So make it after tax. We just multiply this by 0.8. That's 1 minus the tax rate. Oh, we need the equal here. Bam, there it is, 6%. What's next? we need to multiply these by the percentage of firm value in equity, in preferreds, and in debt. Okay, so if we have 50 million in debt, that'll be okay, let's say debt value, equity value, and preferreds value, and we have firm value in total. Confusing with face value, so just gonna firm. Let's say 50 million. How much is the equity value? Shares outstanding 20. How much is the share price? We don't have it. Okay, let's give it a share price. Is, let's say, share price is say $6, right? So equity value, 20 million shares outstanding times 6 is going to be 120 million. And the value of preferred stocks, we have 5 million shares at the price of 110. Let's change it. Let's make it $1 and $11 per share. In that case, the returns don't change. Okay. In that case, 5 million times 11 is going to give us 55 million here. Otherwise, it's just too much in preferred stocks. Okay. Add them up, and I need the weights. F4. There you go, right? What I've just did here, I typed the numbers by hand. Never do this. Never do this. Always equal this number. Otherwise, because of the rounding, your answers will be incorrect. And you will get a really bad score on the exam. Click here, equal. Click here, enter. For rounding, your numbers will be incorrect. Equals this, enter. Okay. So this also reminds me, let's have 4 digits after the decimal point, okay? Let's have 4 digits after the decimal point. Let's have 4 digits after the decimal point. And this also reminds me, why 4? Because usually you use X as your last digit of your student ID. This time we're gonna use X as the last 2 digits of the student ID. So read every exam question carefully. The very first question is going to ask for your X. And it's not the last digit of your student ID, it's the last 2 digits of your student ID. So if your student ID is 11178111111, your X is 11. Okay? Right. So for that reason, there might be X's that are 11, and there might be X's that are 12, there might be X's that are 87, and there might be X's that are 88. Not much difference between 87 and 88, so I can see the difference in the answers. I want to have, let's say, at least 4 points, 4 places after the decimal point. Okay. So for weighted average cost of capital, it's just this times this plus this times this plus this times this, right? There it is, in total 10.54%. Okay, so that's weighted average cost of capital. Do we have anything else in this chapter? There is something on, yes, there is something on securities market line. Where is the securities market line? Maybe it was in a different chapter. Okay, anyway, there is something on stocks being overvalued or undervalued. Okay, that's a comparison between the required rate of return versus expected rate of return. Okay. Open Paint like this. As we had it several weeks ago, we have securities market line like this, right? The relationship between risk and return. Call it required rate of return. Although the textbooks sometimes really confuse the required rate of return and the expected rate of return. Where can I find that confusion? Let me see. Here's required versus expected rate of return. Here's an example of a confusion. These textbooks sometimes do confuse that. Maybe I'll have to rewrite those. So here's ER. Usually E of R means expected return, but here it's called required rate of return, right? There are more examples like that. Anyway, so we were in Paint. So even if the beta is 0, there is still a risk-free rate of return. Even short-term government bonds do provide some risk. Do provide some return. That's this point over here. What happened? Okay. After that, the more the risk, the higher is required rate of return, right? Otherwise, why would you invest into this stock A if it's more risky than the government bond but doesn't provide more return? You would require higher return if it's more risky, right? So this is the minimum that you would require, but in reality, if it's actually providing an even higher rate of return, this is the expected rate of return for this stock, and this is the required rate of return. In this case, this stock is undervalued. Even though the return is over the required, the name is kind of the opposite. It's undervalued. Why? Because the price is too low. That's why undervalued. If the price is too low, your return is going to be really good. Right? Let's look at stock B. Here's the required rate of return for stock B. That's the required. In reality, if it's only providing very little return, it's overvalued. Why overvalued while it's stock B providing expected return so low? Well, because if you buy it at a very expensive price, you would expect to make little money. That's why it's overvalued. The price is too high. So there's that. And the last chapter. Okay, last chapter is on capital structure, the percentage of total assets in the company that come from debt versus equity. Okay, and there are only three things to calculate in this chapter. Break-even EBIT. So generally, let's delete all of this. Generally, okay, earnings. If your earnings are quite poor, anywhere here, right, then you're going to do better without debt compared to the situation with debt. The situation with debt is the red line. Okay, you see, your black line is higher. So when your business is not doing well, you will be happy that you didn't borrow money, right? Clearly. But if your business is doing really, 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 really well, right? You open up this new designer shoes store and your business is doing extremely well. You would be thinking to yourself, I should have borrowed more money to open 2 stores rather than 1. Because everybody wants to buy my shoes, right? So in this case, leverage is actually very beneficial, right? So at some point between business not doing well and business doing very well, at some point, right, having debt or not having debt doesn't really have much difference, and that's called break-even point. That's what we see here, break-even earnings. This is earnings before interest and tax, right? So over here we have EBIT. And over here is our earnings after tax, that's earnings per share. Okay, EPS, earnings per share. So to find this break-even point, you need to equate EBIT, you need to equate earnings per share with and without debt. Okay, with and without debt. In the textbook, unfortunately, this is a very simple example. They assume tax rate is equal to 0. They assume tax rate is equal to 0. In a more interesting realistic example, tax rate is not going to be equal to 0, so you'll have something like minus the tax rate here. Right? And minus the taxes here, so we can just multiply by 1 minus the tax rate. Like this. And here, this whole thing multiplied by 1 minus the tax rate. Like that. Okay. That's one thing to calculate in this chapter. Second thing is tax shield. Because due to taking on debt, we'll have to pay less taxes. That's pretty cool. Okay, where is the tax shield? Here. We'll have to pay less taxes. And tax shield is actually equal to the interest payment tax times the tax rate. Okay. Let's write it down here. So tax shield, interest payments times the tax rate. Okay, you might need that. And the last thing to calculate in this chapter, where is it? Over here, is the present value of all future tax shields. Okay, it's just the tax shield. It's just the tax shield divided by that returns. Okay, that interest rate. That actually cancels out. So another way to calculate the tax shield. Another way to calculate the PV of the tax shield. That's another formula. It's already PV of this tax shield. Another way to calculate it, because the rates cancel out, right, is just total debt multiplied by the tax rate. And that's mostly it. The rest is just theory over here. Again, no theory questions in the exam. Let's come back to where we were. 4 chapters. Okay. So one more time, a reminder. Week 17, there is a forum over here. Click it. Anyway, click it. Click on the forum and answer the questions just in your own words. Right? That's a reminder for those who was late. What else? Starting tomorrow, 10:30 until 12:30 is your exam. Just 2 hours. Don't be late. Yeah, I think that's mostly it. So, questions? Questions? No questions? Are you sure? Okay. Well, anyway, you still have 1 week. If you think of some questions by then, you can try to find me or shoot me an email. Right? Yeah, I think that's all. No practice tests for today. Lastly, any questions? Bye-bye. Bye-bye, bye-bye, bye-bye.
Thank you.
Good.
Thank you.
Oh,
Professor,
yeah, I
you
forgot to
you
check
didn't
attendance,
took
right? Some
attendance.
people already left.
Oh.
No, nobody's left, I think. Still 18. I haven't seen anybody leaving. Okay. Sorry, Ricky, to interrupt you. Let's check attendance. Let's go to this. What is it? Chat box. Yes. And everyone type in your student ID. Okay, 5 more seconds. Type in your student ID in the chat box. Okay, let's check if I'm recording. I am recording. So I'm just gonna scroll through the chat box. We have a recording of this attendance. Okay, done. Ricky, your question.
No, I just say bye-bye.
Oh, right. Good. Good
Yeah.
luck, guys. Good luck on the exam and bye-bye.
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 Thank you, Professor.
Thank you.
Right.
Hey, Professor.